Hi, everyone. We're just giving folks another minute to come in and we'll get started shortly. All right, we're at the top of the hour here, so we'll get started. Hello, everyone. Good afternoon, and welcome to this episode of Totum Live. My name is AJ Bory. I'm the Chief Marketing Officer here at Totum by TIFIN, and we're delighted to have everyone join us here today. This afternoon, we'll be showcasing how Totum and Franklin Templeton's model portfolios can benefit your clients' investment strategies. Today, we'll be joined by three presenters. The first being Adam Gorlyn, who is the Senior Client Portfolio Manager at Franklin Templeton, Dan Ruggiero, the Sales Director for Private Wealth Platforms at Franklin, and Will Naas, the Director of Advisor Sales here at Totum. The agenda for today, we'll be going through an overview of Franklin Templeton's model portfolios, then an overview of the Totum platform, as well as a demonstration on how advisors can use Franklin's models to meet their clients' investment strategy needs. As a quick note, we have a Q&A box that you can find at the bottom footer of your screen. Please feel free to ask questions along the way. And in addition, we'll have a dedicated question and answer section at the end of the webinar. With that, I would like to hand over the presentation to Dan to begin. Dan?
AJ, thank you so much. I appreciate it. As AJ mentioned, my name is Dan Ruggiero, part of the Private Wealth Platforms team at Franklin Templeton. We've definitely enjoyed a very successful partnership with Totum over the past several years, and we certainly appreciate Totum having us participate on this webinar to discuss the Franklin Templeton Model Portfolios, and really more specifically, how they can help your clients achieve their desired outcomes while helping you, the financial advisor, grow your business. AJ, if you could pull up slide 6. So before I turn things over to my colleague, Adam Gorlyn, I wanted to provide you with a brief overview of Franklin Templeton and really highlight what differentiates us and our model portfolios. Franklin Templeton provides our clients with global strength and with boutique specialization. Again, global strength and boutique specialization. And what I mean by that is, in terms of global strength, Franklin Templeton manages over $1.5 trillion in assets under management with over 1,200 investment professionals around the globe. Franklin Templeton also has one of the largest client-facing sales forces and marketing teams in the industry. And what that helps us do is provide financial advisors with a surround sound coverage and support model to help you grow your business. AJ, if you can move on to the next slide, please. But what we really feel sets Franklin Templeton apart is that we bring together a group of independent specialist investment managers. You should be able to see them on the right-hand side of the slide. And those independent investment managers provide clients with deep expertise across virtually all asset classes, investment styles, and geographies. So now I'm going to turn things over to my colleague, Adam Gorlyn, who's going to discuss the Franklin Templeton model portfolios and how they're able to translate a wide variety of investor goals into models that are powered by Franklin Templeton's best thinking from around the globe. So with that, Adam, the floor is yours.
Sure. Thanks, Dan. Thanks, everyone, for taking a few moments in what's traditionally been a very busy week as folks wrap up the new year, whether it's month-end business or hopefully some holiday lunches or dinner. So again, we appreciate you taking some time from your day to meet with us and understand our model portfolio business. As Dan pointed out on the prior page, I'm part of the Franklin Templeton Investment Solutions group. We're over $100 billion in assets under management, and we're led by our CIO, Ed Perks. In a nutshell, the Franklin Templeton Investment Solutions Group is set up to manage asset allocation-based solutions to meet client-specific goals. So whether the goal is growth of capital, income, or perhaps tax-advantaged income, we believe that we have the know-how to construct those investment solutions either via a mutual fund, perhaps for a pension fund separate account, or in this case, model portfolios. As you may not know, Franklin Templeton has been in the model portfolio business for over 20 years. The rise of Reg BI and the push towards advisory business has really been one of the major forces behind the growth of the model industry. And we've seen that pick up as of late. AJ, if you go to next screen, please. We believe that the Franklin Templeton Investment Solutions research-focused approach to building model portfolios, specifically within multi-asset space, uniquely positions us relative to competitors. The FTIS, or the solutions team, meets on a weekly basis, and we rotate from topic to topic, whether it's equities, fixed income, the global macro environment, or alternatives. We're able to pull all of the research and the ideas together that come from the various investment units from across Franklin Templeton. Today, those units can include such brands as ClearBridge Growth or ClearBridge Equity Growth, and of course, Western and their prowess in the fixed income space. One of the main outcomes of our investment committee is espousing forward-looking views on major asset classes. In addition, understanding expected correlations and performance drivers further informs our portfolio management team and sets the tone for the relative overweight or underweights in our respective portfolios. The overweight could be to equity and underweight to fixed income is the simplest way to think about that. Our team, or the solutions team, utilizes its own research in addition to the ideas that come from across the broader organization to construct the framework to apply these investment views. We utilize both fundamental and quantitative research, as you see on the screen, as well as macro, thematic, and specific asset class research to pull these views together, apply them in a portfolio, assemble, test, validate those theses, and make sure that those portfolios are updated with our forward strategic policy views. That part, AJ, if you go to the next screen, that part of active portfolio construction is another differentiator of our model programs. Active management is applied not just at the underlying fund level, so there's an expectation here, so underlying funds or underlying ingredients will be actively managed, but clients should expect that the active allocation views expressed in our mutual funds and separate accounts will also be applied in these model portfolios. That thesis or that way of thinking or that approach to active asset allocation is a hallmark of Franklin Templeton, and we expect it to be utilized going forward in these model portfolios. On a asset-specific basis, if you just want to go back one slide, clients should expect that the amount of U.S. equity, non-U.S. equity, and emerging markets will be updated on a frequent basis. We could also dial up or dial down the style exposure, how much core, how much growth, how much value. Similarly, market cap. All these ideas and all these theses will be reflected in the model portfolios. The same is said on the fixed income side, with a regional bias expressed in the portfolios. And then finally, calibrating exposures in terms of projected credit quality, as well as duration and yield curve. All of these are updated on a frequent basis in our portfolios, and clients should expect the portfolios, it says on the top of the screen, to be updated anywhere from 4 to 6 times per year. Let's take a moment, AJ, if you go to the next screen, to talk about our model portfolios. There's essentially a couple more slides, AJ. You can stop right there. There's essentially a suite of 3 different underlying strategies within our model portfolio group. A core allocation, which is designed to produce an expected return given a level of risk. An income suite of strategies, which as the name suggests, is there to throw off or generate high current yield for clients. And then the thematic or specialty, which today we're going to reflect via our tax advantage income models. AJ, if you go to the next slide. As I said, in terms of core allocation, the models seek total return with the client's risk appetite or tolerance for risk being reflected in the amount of equity exposure that's being applied in the underlying portfolios. We think that the total risk scoring system is also a way to differentiate the objective of each of these models. You'll see that the models are easily mappable to the underlying risk profile of your client. And again, this is going to be driven primarily by the amount of equity risk that's being taken. Let's go to the next slide. Here you have a snapshot of what the model portfolios look like, or the core allocation model portfolios look like. Going from the left to the right-hand side of the page, the amount of equity in the stability portfolios is relatively low, with a neutral weighting of roughly 20% equity. Going to the right-hand side of the page, the equity growth model portfolios, approximately 100% equities with an expectation for zero or no allocation towards fixed income. Looking at the models as from a top-down level, you'll see good differentiation by manager style and brand, good differentiation by vehicle, incorporating the use of both active ETFs and active mutual funds. And let's talk a little bit about how our exposure is set up at the moment. The moderate growth, the one in the middle, is the easiest way to understand this. Looking at the portfolio, you'll see 64% in equity. So we're expressing a moderately risk-on view in the equity market as we speak. From an equity allocation perspective, the lion's share of the allocation is built within US equities with a core and growth tilt employed. Some of the best known names within Franklin Templeton's broad array of managers are expressed there via the use of ClearBridge Large Cap Value and the Franklin Dynatech Fund. The Liberty Q ETF is our best way to express the quality bias that we expect or that we're seeking to implement in our portfolios as of today. Non-US exposure is moderately less than US exposure, so our models are built to have a slight US bias to them. And within non-US equities, we favor developed markets relative to emerging markets, as there seems to be a lot of noise emanating from China these days, impacting the rest of emerging markets. On the fixed income side, you could see that we're slightly underweight fixed income with a roughly 36% allocation. The fixed income exposure is very much focused on the US aggregate space, and we're applying that via the Franklin Liberty Core Fund, as well as the Western Asset Core Plus Bond Fund. Select plus sector exposures are expressed in the portfolio via the use of the floating rate fund, which is bank loan fund, as well as global, seeking non-correlated or low correlated returns relative to core fixed income or core fixed income US aggregate assets. Why don't we go to the next page, AJ? Second suite that I mentioned at the onset is our income model portfolios. The income model portfolios, as I suggested before, their job is to produce a high current yield, and capital appreciation is secondary. This is meaningfully different than the core allocation models, which are designed specifically for total return. AJ, if you go to the next slide. Looking at the income models on the right-hand side, the income model itself, notice on the bottom right-hand side of the page with a current yield of approximately 3.53, which is almost double that of what's available in the US aggregate space. Similar to the core allocation models, the income series is set up to be well diversified by underlying brand and strategy. Although we do point out that there's a sizable allocation to the Franklin Income Fund, which is a large income-focused mutual fund, one of the best sellers in the industry, which is designed, no surprise, to throw off a high current yield on a monthly basis. Currently, that fund yields about 4.7%. From a fee perspective, you notice the funds, or the models, I should say, currently carry an average fee of about 40 basis points, which we think, similar to the core allocation models, quite competitive relative to what's available in the industry. And we offer that without the cost of an overlay fee from Franklin or from Franklin Templeton Investment Solutions. The growth in income and the enhanced growth in income strategies also throw off significant yield for clients, outweighing or out-yielding, I should say, that of the aggregate and of the S&P. And you can see the yield on the bottom of the page, about 3% for the growth in enhanced income, 2.84 for the growth in income. The trade-off in this series is the amount of equity that's added to the portfolio. As you could see in the gray bar on the top, the more equity that comes into the portfolio, the lower projected yield is for the portfolio. the trade-off being the amount of potential upside that investors can capture from equity market appreciation. AJ, if you go to next slide. Just wrapping things up, I mentioned before tax advantage models. Franklin is known well in the municipal industry, has a pretty viable and sizable municipal franchise. And the tax advantage series is set up exactly to take advantage of that municipal business or the prowess in the municipal business. Looking at the bottom center column, the tax advantage income model is currently yielding 3.23 or 3.25, which we think is quite healthy relative to what's available in the marketplace. We generally carry a rule of thumb that about 75% of the yield in these models would be derived from municipal income. So there's a good blend here of municipal as well as taxable exposure with a focus of tax-free exposure in these models. Again, good diversification by underlying manager, healthy yield, and respectable fees for active strategies that are participating in the municipal space. AJ, if you go to next slide. We do have performance that's in the book. We're happy to go through that. And AJ, why don't we just talk about the advisor resources that are available on the next slide. And I think, Dan, you're going to join in and talk through these slides with me.
Yeah, Adam, thank you very much. As I had mentioned in my opening remarks, one of the key differentiators of Franklin Templeton as a whole is the tremendous sales and marketing force that we bring to the table. We're not simply providing these models to a financial advisor and walking away and never hear from us again. That's far from the truth. As you see on these slides here, Franklin Templeton offers a variety of product-specific marketing guides, as well as more thought leadership and value-add marketing pieces that are available to you both via our public website or via your respective Franklin Templeton sales professionals. So some of the things you see listed on the page here, again, we offer both client use brochures and fact sheets, monthly trade trackers, and updates on the models you own, why Franklin Templeton Investment Solutions are making the changes they are. And I think one of the key pieces that, in my opinion, gets used the most and is very, very helpful for both financial advisors and clients is the tip sheet. And AJ, if you could move forward a couple slides, I'll tell you where to stop. Next one, next. Keep going. There we go. The timely investment positioning piece, or TIP. This is a very easily digestible piece. It's a 2-pager that helps financial advisors and clients understand Franklin Templeton Investment Solutions thinking across a wide variety of asset classes, as you see listed on the left-hand side of the screen there, along with some commentary around monthly thoughts and outlook for each one of those respective asset classes, and why we're either overweight, neutral, or underweight to those respective asset classes. So again, the core story here is that Franklin offers a wide variety of marketing pieces and, of course, sales support to help you as the financial advisor use these models to help your clients reach their desired outcomes and grow your business, as we stated earlier. Adam, anything else you wanted to add there regarding the surround sound support?
Thank you, Dan. We understand the value of everyone's time, and understanding the partnership between Franklin and yourself is something that we think further differentiates our model or our model capabilities relative to competitors. We know that having simple, easy to understand positioning pages, if you want, AJ, you want to go back a couple of slides, that reflect our trade tracker. Go back 2 more, please. I'm sorry, that are reflected via our trade tracker. This is a piece that's sent out every time that we make a trade or a change in the underlying portfolios. As I said, we expect to trade portfolios 4 to 6 times per year. And we explain those trades, or we explain the rationale for those trades, and keep you updated in easy to understand bite-sized bullets And then you can see on the second imprint on the page, we highlight where the changes are in the respective model in the green and red right there in the center of the page, green and red numbers on the center of the page. Again, communicating the changes on a timely basis, an easy to understand format, we know is a vital component to a strong partnership between yourself and Franklin Templeton. A couple more points to make on the following page. As you'd expect with any mutual fund or any separately managed account strategy that you may be offering to your clients, there's often a quarter end deliverable. AJ, if you go one page further. And no surprise, the model portfolios are set up to deliver that as well. We will publish on a frequent basis the underlying holdings, the underlying weights to those holdings, along with any market insight or other rationale that may have occurred during the quarter update. Finally, the tip sheet that Dan walked you through right out of the gate is a separate piece that's also disseminated digitally or via email. And this simply just reflects the investment views that come from my team from the Franklin Templeton Investment Solutions. Again, easy to understand, bite size, incorporating major asset classes, relative overweights and underweights. The models obviously will follow this framework as this expresses our investment views. But for those investors who are simply just looking to follow our investment thesis and understand where we see opportunity, the tip sheet is a great way to track those views, as well as supplement all of our portfolio changes that happen on a month-over-month basis. Let me stop there, AJ.
Yeah, Adam, we have a couple questions coming in from the viewers here. The first one, somebody asked, can we provide examples of these documents? I think that's pretty easy to do. So Dan and Adam, if you provide some examples of the latest and greatest from Franklin Templeton, we can include those as downloadable links when we share the playback to all the registrants for the webinar. And the second one here is, are these models available in various share classes? For example, advisory and A for brokerage.
Sure, I'll take that one. The models and the track record and the performance that's included in this presentation is all reflective of what's called our institutional or advisor share class. When we build these model portfolios and we share the trades, we're assuming that clients are utilizing the models in a wrap program or UMA type structure, where advisory or institutional share class, where the cheapest share class available is expected by the client. We do not offer the models via a share class. We do have clients who simply follow our asset allocation though and employ the models or utilize our funds to employ our views via a share class, and they could do that via brokerage.
Yeah, and Adam, to add on top of that, I agree with everything you said. We understand that depending on what custodial firm each advisor is using, some share classes are no transaction fee versus transaction fee. To Adam's point, we generally do try to employ the no transaction fee share class option within these models, which at many custodial firms is that institutional or advisor share. So that's a little more color around why we use that class I share or advisor share within these models that you see on the screen.
Okay, great. Dan and Adam, any other points that you would like to make before we shift over to Will?
Go ahead, Dan.
Yeah, AJ, just, before we turn over to Will, and I don't want to take up too much more of your time, Will, but if you could turn back to slide 7, because again, I think it's one of the key differentiators of what Franklin Templeton brings to the table in terms of these model portfolios. I was having a conversation a few weeks ago with a financial advisor and mentioned models, and he said, stop right there. I don't use models. Oftentimes these model providers are good at some asset classes, but they don't know what they're doing in other asset classes. And I can tell you that's not the case with Franklin Templeton, given our unique structure and the fact that we bring together, as you see, 18 independent investment platforms and managers. Each one of those managers is an expert and a specialist in many cases, one particular asset class. All Western Asset does is manage fixed income, and that's all they've done for the past 40 plus years. All Martin Curry does is manage international and emerging markets. Royce, all they do is manage small cap equity. My point being, each one of these managers who is managing the underlying sleeves of these model portfolios is an expert in their respective asset class. And again, I think it's really what helps set Franklin Templeton and our model portfolios apart from the rest of the pack. So again, I really appreciate Adam running through all this. And I'll turn it over to Will now to go through the Totum risk software piece.
Thanks, Adam and Dan. I appreciate that, and thank you everyone for joining today. I'll echo Adam and Dan's sentiments there. I know we're coming to the close of 2021, and really there's no better time than now to take a look at your practice and see how we can improve client experiences, wade through some of the noise that we've heard here in 2021, and use a best-in-class money manager, like Franklin Templeton, to build portfolios that can address a client's risk tolerance and accurately gauge, some risk-return profiles. So, AJ, would you mind moving on to the next slide? So, Totum, first and foremost, we are a part of a larger fintech ecosystem that's owned and managed by TIFIN. TIFIN is simply a collection of companies that is focused on improving investor experiences and outcomes. As you can see at the bottom of the page, we have a couple big name strategic investors like JP Morgan, Broadridge, Morningstar, and Hamilton Lane, all putting their money behind TIFIN because they believe in what we're doing. Now, where Totum falls in is we are the risk tolerance platform, and we spoke with regulators from the SEC, FINRA, and the states, and they all defined risk tolerance as a client's willingness and ability to take on risk. AJ, next slide, please. In further conversations with those regulators, we realized that there were almost 4,000 cases filed against advisors last year. It's no surprise why. When markets get tumultuous and we're only looking at one real risk score, which is emotional risk preference, it's easier for clients to file suit against advisors. Cost of arbitration can be incredibly expensive, and with traditional risk tolerance tools, that includes other platforms as well as pen and paper questionnaires, they really only tend to focus on emotional risk preference rather than financials-driven risk capacity. Issues there is that if you were to ask your clients, hand them a questionnaire and ask them how they felt about gains and losses and how they felt about the markets in November of 2019, turn around and gave them the same questionnaire 6 months later in May of 2020, how different do you imagine their answers would be? And in conversations with many advisors, they realized that only scoring a client's emotional risk preference is a constantly moving target and almost impossible to consistently hit. So with that being said, Totum, AJ, next slide, please. Totum scores risk in 3 different ways. We do still score a client's risk preference. We believe that their investment experience, as well as their feelings about the markets, are still important. But then we use their financial data, their actual human capital factors, to score their risk capacity, their actual ability to take on risk. And then through our integration partners, we can bring in current portfolios, give those a score as well. And what regulators would like to see is that the portfolio falls somewhere between risk preference and risk capacity, giving you, the advisor, a little bit of wiggle room to explain to the client and really custom tailor a portfolio to their needs and their overall financial objectives. Now, what makes us even more different is most risk tolerance platforms will use standard deviation in order to score risk. 95% of all occurrences will happen within those 2 standard deviations, making a 95% confidence probability. Totum uses VAR, or value at risk, in an effort to score your clients' portfolios as well as their preference and capacity. Now, value at risk is a 99% confidence probability, and it focuses on loss, which gives these numbers actual meaning. So what I'd like to do is go ahead and dive into the platform, show you the questionnaire, some of the workflows, and how we can utilize a money manager like Franklin Templeton in an effort to gauge those portfolios and get clients into a better risk-adjusted scenario. All right.
Stop my share, and then Will, you can take over from here.
Excellent. All right, so here we have the Totum Risk platform. Now what you'll see is there's two different workflows. We have a prospects tab and a clients tab. So let's start with a prospect. This is something that, as you're heading into the new year, everybody's attempting to grow their business. And we're going to, sit down with some prospects here in January. As you can see here, I've got a couple prospects who have taken the questionnaire and one who has not, which is me. For that prospect, it's as simple as clicking send. And we give you the ability to either send the questionnaire directly to that client's email using our pre-built template. You can copy the link and throw it into a more personalized email for that prospect, or you can take the questionnaire with them over in the office via Zoom or over the phone. I'll take you through the questionnaire because a lot of times what we've heard from advisors is that questionnaires can be either A, too long, or B, too confusing for a normal client to be able to understand what that questionnaire is really asking. Our questionnaire is 12 simple and easy questions that will really gauge a client's risk capacity as well as their preference. We have 8 questions that will score their capacity, 3 questions that score their preference, and 1 that is strictly for compliance. So as we dive in here, we like to start the clients off nice and easy, giving them some questions that are easily answerable, and then we dive into the meat and potatoes later on in the questionnaire. First is age and annual pre-tax household income. Next, we have people in the immediate household, including dependents. So we separate dependents for 2 different reasons. 1, if you have any kids, you know that they're anything but cheap. And 2, if you do have dependents that live with you full time, you do get tax breaks for that. And we are up to date with current tax codes, and we calculate that into overall risk capacity. Next, we have annual household expenses. If your clients are anything like my wife and I have no idea what I spend annually, but I do have a very good idea of what I spend monthly. We do have a nice little monthly calculator here breaking out some of the normal monthly expenses, as well as a couple other lines here in an effort to really gauge that net cash flow. Same thing with total net worth and liability, or total net worth, assets and liabilities. The clients don't know exactly what those are. Another little breakdown here. Clients can enter in the information, it will put it into their net worth. Next, we have total investable assets and the time frame on which we are going to start distributing those assets. Now we have where you live and whether you own property. So we asked this question for a couple different reasons. First and foremost, the cost of living in Manhattan is going to be a little bit different than it is in Denver, Colorado, where I live. Whether you own property, certain counties and certain areas have higher property taxes than others, which can dramatically affect your overall capacity for risk. But using machine learning and AI, we will actually pull in a lot of back-end data just based on where you live. We'll pull in median income, major industries that operate inside that zip code, as well as median home price. Next question is which industry client currently works in. We understand that some are cyclical, oil and gas, real estate, financial services, retail. Into the consistency of household earnings. How consistent are those earnings over the next 12 months? Health and health of the household. We understand that this is an invasive question. However, what we're asking is just whether we need to plan for healthcare needs, not necessarily what those needs are. Now we get into the preference questions. This is the meat and potatoes. Instead of asking the client for your hypothetical $50,000 investment, if markets fell 30%, would you buy more, sell, or jump off a cliff? We're going to make this a very real scenario for this client. Whatever they typed in for total investable assets will show up here in the middle. Question is, for this investment, what is the maximum 1-year loss you could withstand or to potential gains later? Sliding scale. Not only does it give the client the percentage, but also the hard dollar amount of what would be lost and what's left in the account. Now we get into some game theory. So we're going to flip a coin. Would you rather take a guaranteed gain or flip a coin? Heads, you gain double. Tails, you gain nothing. Same thing with loss preference. Would you rather take a sure loss or flip a coin? Heads, you lose double. Tails, you lose nothing. Finally, we have our compliance question. They always love to see that we are planning for something. So client can enter in up to 3 key financial goals and give you some talking points for that annual review or that first time meeting. Once clients completed the questionnaire, it will spit out their risk preference, their risk capacity. Now, for a prospect, chances are in your first time meeting, you don't have their portfolio in hand. What we can do is actually assign them a portfolio. So we can come here to assign portfolio, add, and you can either start from scratch, entering in the tickers and allocations. You can upload a CSV file, or you can select from our models. Once that portfolio is in, we can come here to generate proposal. So for this particular client, I'd like to show you what their current portfolio is and how we can utilize Franklin Templeton in an effort to give them some better risk-adjusted returns. So,
Will, before you hop in there,
Yeah.
we got one question from the crowd.
Sure.
One of our viewers wants to know, can they make adjustments to the questionnaire?
So you can add as many additional questions to the questionnaire as you'd like. It will not affect the risk score, but if you're using a current fact finder, you don't want to have two separate questionnaires. You can actually aggregate it into one. As for those 12 questions, those are preloaded and cannot be changed. We need those in an effort to score the client's risk capacity as well as their preference.
Great, thank you.
No problem. So under the view or assign portfolio, we can actually view where they currently are. So currently this client's using an SEI, an SEI portfolio. It does fit within their risk band, but let's see if we can actually give them a better risk-adjusted return. Under generate proposal, we can generate an IPS. This is all white labeled to you and your practice. So your logo would be up here in the top left, your information top right. We've selected the Franklin Templeton Moderate Growth. We believe this was fit inside their risk band. We've got a welcome letter welcoming the client to you and your practice. We've got their current risk profile, risk preference, risk capacity, and current portfolio. The questionnaire and the answers. Great thing about this is some clients have selective amnesia. They complete a questionnaire, they forget what they actually said. If there are any discrepancies, you can address that there in the meeting. Now we've got the summary of accounts. Now I can zoom in a little bit here, make this easier to read. So we have our current portfolio here on the left, proposed portfolio here on the right, which is the Franklin Templeton Moderate Growth Model. Adam went over that in his presentation. Not only can we see that we're offering a better risk-adjusted return, so the upside potential is greater, but the expense ratio is lower. We see each individual holding inside of this portfolio is also given a VAR score. Next, we have the historical performance. So we're looking at previous performance of these two portfolios. Once again, better risk-adjusted return. We use 1,000 Monte Carlo simulations to project future returns for both portfolios. Duties and responsibilities page. This is where the client would sign and date, showing that you reviewed their overall risk tolerance, their current portfolio, and any proposed portfolios. And the last page, of course, is disclosures. So those are the prospect workflows, but how can we work with current clients? So current clients, go to our client workflow here. And with a current client, chances are they're already integrated. So we can just simply come here to our check compliance tab, and you can see all the clients that need to be adjusted. So their portfolio falls outside of their risk band, as well as those that are currently aligned. So if we just wanted to see the clients that need to be adjusted, let's take a look at Dory here. We click it, adjust, and we can see that this portfolio currently falls outside of their risk band. Now we're still using a Franklin Templeton fund. It's been great for us, but maybe this client's gotten a little bit more confident in the markets, and their risk capacity tells us that they can actually take on more risk. So in an effort to help them reach maybe some loftier financial goals, what I'd like to do is maybe select from a new model and show them how Franklin Templeton can improve some of those experiences. So we go to select from models, come here to our Franklin Templeton tab. It's actually going to show the 3 portfolios that fit inside of this risk band, giving you the ability to talk with that client, see what those goals are, and do we want to be closer to their capacity, or would we rather be closer to their preference? So let's go ahead and select the growth model and see what that looks like. So yes, we're adding a little bit more risk to this particular portfolio. We're helping this client reach maybe some loftier financial goals, maybe retiring a little bit earlier than 65. We can see the upside potential has gone from 12% all the way up to 40%. Individual holdings as well as the historical performance. Historical performance can be adjusted to whatever time frame you'd like to show. So if we wanted to show the past 20 years, we could show a client how we've nearly doubled their investment, whereas the previous portfolio grew by about $10,000. You can also stress test your portfolio. So if the client's concerned with the next black swan event, we can look at the global financial crisis, the dot-com crash and recession, or maybe the 2013 rate increase. There's been a lot of noise that Fed's looking to increase rates. Maybe we want to see how our portfolios can perform during a rate increase. Once again, you have the ability to generate an investment policy statement. Oops. So you do have that ability to generate the investment policy statement and propose that to your current client during your annual reviews. I'll leave it open for any additional questions or concerns.
Great. So with that, we'd like to open it up to all the viewers. If there are any additional questions on Franklin's models or the Totum platform, please let us know. Will, looks like we have one question here asking about pricing of the Totum platform.
Sure. So as for pricing, it is $99 per month per user. So if you have any admin staff, paraplanner, anything like that, they do not need a subscription. So per $99 a month per advisor.
AJ, I see a question came in asking me to address where the materials can be found for the Franklin Templeton models. Just worth pointing out that they are available on the public website. And we are working with Totum to be able to post the deliverables to the Totum website as well to make them more readily available.
All right. Will, do you mind closing your screen out? And I'm going to bring up the contact information for everybody here. So if there's no other questions, I just want to leave you with this. If you have any follow-up information that you would like or want to get a hold of either the Franklin Templeton team or the Totum team, here's the contact information for both Dan and Adam, as well as the URL. And you don't have to write this down. Again, it will be in the playback when we send it out to everybody after this event. The URL where you can find more information on the Franklin Templeton models. And if you would like to get a hold of Totum, we invite you to either visit totumrisk.com or you can send us a note at contact@totumrisk.com. So let me do one more check if there's any other questions. If not, I want to thank everybody for attending this session of Totum Live, and please enjoy the rest of your day.
Thank you. Have a great
Thanks again,
holiday.
everyone. We appreciate it.
Thank you.
Thanks, Dan. Thanks, Adam. Thanks, Will.